So the next session is about valuation. It is an important topic. In particular, there are a lot of questions in the practice whether there's an expectation gaps on valuation. And in fact, the IOSCO just released a statement a few days ago. Let me just quote it, making sure I have the right quotation. IOSCO emphasizes the need for international consistency of high-quality valuation information included in financial reporting to provide investors with relevant and reliable financial information. And that statement was just being released just a few days ago, which is very timely because our research today about this topic, valuation, is hopefully will answer that question. With that, I'm going to invite Janani to do the introduction and host.
Thank you, Eric. My name is Janani, and I'm a graduate here at the AASB, and I'll be introducing our next research session, Valuation, Disconnect and Expectation Gap, delivered by Dr. Mark Wallace from the University of Queensland. Mark is a senior lecturer in accounting and an expert in corporate valuation and financial statement analysis, having taught these subjects for over 7 years. His research examines how financial accounting information interacts with financial markets and has been published in leading journals. Mark has also contributed practitioner-focused research on audit matters, climate-related disclosures, and intangibles reporting in collaboration with CAANZ, the AASB, and AUASB. Please welcome Dr. Mark Wallace.
Great. Thank you very much for the introduction, and thank you to AASB for the opportunity to present. Okay, good, my slides are there. So this is the result of some work that I've done with Professor Matt Pinnock at the University of Melbourne, and it also is a result of a AASB research grant that we were generously given for this year. So this is part of the work that we did. This is the part that we did on non-goodwill intangibles. So as you can see, we're interested in how do firms value non-goodwill intangibles, and also how do investors perceive the value of non-goodwill intangibles. And those questions turn out to be somewhat related. So why are we interested in this? So if you take the balance sheet of Australian companies, that's a breakdown of the balance sheet of Australian companies excluding financial firms and mining firms. You can see that about 10% of the balance sheet is made up of non-goodwill intangibles. So things like brand names, customer relationships, software, development costs, that type of thing. So some economic importance there. Seems to be economically important. And non-goodwill intangibles basically enter the balance sheet in two different ways, two main ways. One is they come in through business combinations. In that case, they come in at fair value. They enter the balance sheet at fair value. And the other way would be internal capitalisation of costs, so historical costs basically. So we're of course interested in the first of those two scenarios, the fair value accounting for intangibles. So the problem is that firms are buying non-goodwill intangibles in business combinations, and they're recognising them at fair value. And the tricky thing is that a lot of those assets would be, those intangibles would be quite difficult to value. So things like particularly brand names and customer relationships, those are intangibles that the acquiree would not probably have on their balance sheet already, and they're quite difficult to value. There's not a deep market for things like for brands. There's not a lot of transactions where you can get data about license fees and that type of thing. And the next thing that is interesting is IFRS does not require disclosure of how firms actually worked out the fair value of identifiable intangibles that are acquired in business combinations. So there's no disclosure requirement in AASB 3 or IFRS 3 as to how the fair values of identifiable intangibles were worked out. But if those same assets were carried under the revaluation model, then firms would have to disclose that type of information. Of course, it's very rare that intangibles would be carried under the revaluation model, but if they were, firms would have to disclose things like the valuation method they used, key valuation inputs, that type of thing. So it seems to me that there's kind of a gap in the disclosure here. That firms are buying these intangibles that are difficult to value, and then they're not required to say how they valued them. But I think as an investor, it would be useful to know some information about that, how those fair values were determined. Another part of the motivation comes from the post-implementation review of IFRS 3. So part of the feedback from preparers and auditors, etc., was that intangibles, identifiable intangibles are difficult to identify and difficult to value. So they specifically mention brand names and customer relationships. And the IASB had two potential responses that they listed. So one would be just basically don't have as many identifiable intangibles, just subsume more of the intangibles within goodwill rather than recognising them separately. And the other option would provide some more guidance in the standards as to how to identify and value intangibles. So that's part of our motivation as well. So we've got two research questions that we're going to look at that are related. So the first one is, what do firms disclose about how they value intangibles in business combinations? I've just said that there's no requirement to disclose this information, but do firms voluntarily provide that? Voluntarily disclose information? And if they do, what do they disclose? What valuation methods, for example, do they disclose using to value these identifiable intangibles they acquire in business combos? And surprisingly, there doesn't seem to be any academic research on this. I couldn't find anything out there. So this will be sort of the first study of that, I guess. Now, related to this is some related background is the International Valuation Standards. So Eric has, I think, just sort of mentioned that. But basically, this would sort of be where you'd have to go to for more guidance about how to value intangibles, because AASB 13, the fair value standard, it doesn't have any specific guidance for how to value intangibles. Instead, you would have to go to something like the International Valuation Standards. There's more guidance in there for potential ways to value intangibles. And IVS 210 gives these 5 potential income approaches to valuing intangibles, And the first two are the two that are most important: multi-period excess earnings model and the relief from royalty method. So the first of these is basically the present value of the extra earnings or net cash flows that the firm expects to earn from owning the intangible. And the relief from royalties is basically the royalties that the firm expects to save from owning an intangible instead of having to license it. So those two turn out to be the most commonly used. But yeah, we would expect if firms are going to disclose what valuations methods they use, maybe they'll disclose using these methods here. So that's the first research question: what are firms disclosing voluntarily about how they valued intangibles? The other one is, how do investors perceive the value of intangibles and different types of intangibles? So, do they perceive the value of intangibles that are typically acquired in business combinations differently than they perceive the value of internally generated intangibles, for example, given that firms, the disclosure is perhaps limited. So there's not much research on this topic either. There's just the one paper that I found, which looks at US firms. You can see that King et al. 2024 in RAST. And basically what they did is they showed that they looked at a bunch of American business combinations, and they looked at how the investors value the intangibles after the business combinations. And they basically found that all types of identifiable intangibles were perceived as valuable. One interesting thing they found is that brands and goodwill seem to be valued about the same by investors. So it was indistinguishable, statistically indistinguishable. And then they found that investors particularly valued strategically important intangibles, which are basically big intangibles, and so-called wasting intangibles, which are essentially finite life intangibles, amortizable intangibles. So that's basically the only research that's out there already. Okay, so those are the two research questions. So how did we do this? So our sample, we've got a sort of big sample, and then there'll be a subsample for research question one. So the broad sample is taking Australian firms, so firms that are listed on the ASX and incorporated in Australia. You can see we've got a 7-year period, 2018 to 2024. We set a minimum firm size of $100 million just to keep the data collection manageable. And then we've picked out firms that have a significant amount of non-goodwill intangibles on the balance sheet. So at least 5% of their total assets are non-goodwill intangibles. So we wanted to focus in on these firms where, valuing intangibles will be important. And you can see we've got about 1,600 firm years. And this is pretty comprehensive. It represents about 85% of the total balance of non-goodwill intangibles for Australian companies in the sample period. So I think it's quite a comprehensive sample. All right, so research question one. What are firms disclosing about how they value these things? So for this, we took a subsample of firms that acquired a large amount of non-goodwill intangibles through business combinations in a particular year. So we picked out firms specifically that added non-goodwill intangibles of more than 10% of opening total assets during a particular year. So you can see that results in 146 observations. So these are firms where they're buying a lot of non-goodwill intangibles, right? We do expect them to be most likely to disclose some information about how they valued them. So we basically took these firms and then we went through their financial reports and looked at what they disclosed about how they valued the non-goodwill intangibles acquired in business combos. Now the results are a little bit disappointing. So you can see that we only found that 35 of the 146 firms provided any disclosure about how they valued non-goodwill intangibles that they bought in business combinations. This is a voluntary disclosure, so firms are not required to do it, but we would have expected perhaps firms to do this given the materiality of the non-goodwill intangibles that are being added to the balance sheet. And you can see the different valuation methods. This doesn't sum up to 35 because some firms use more than one method. So if you're wondering why that table has more than 35 observations, that's why. You can see relief from royalties, multi-period excess earnings model were the two most common. And then some firms also used a non-income approach, the cost to replicate. So there you have it. So some firms do disclose this information. It's quite rare. But when they disclose, they typically will say what the valuation method was that they used for different types of intangibles. But they usually don't provide more detail than that. So things like what the key valuation inputs were or how they were determined, they usually don't give you that information. So there's still not that much disclosure. This is an example of a firm that provided more disclosure than most firms. So this is Catapult Group buying SGB Sports. And you can see that they have listed the three major types of identifiable intangibles that they acquired in the business combo. And then they've stated the method they used, the valuation method they used for each type of intangible. And then they've also given some of the inputs, the key valuation inputs that they've estimated there. You can see they've given things like the discount rate and the royalty rate, that sort of thing. But this is quite rare for a firm to provide this much detail. Most firms didn't provide this. So we also decided to do a little comparison to the US. This is very small. We just looked at 15 large US firms, large business combinations in the US, just to see if they provide this information. So is it possible to disclose this information? So if they do it under US GAAP, then maybe it's possible under IFRS. So you can see that we only looked at 15. We could expand this sample. It's just a pilot study. But you can see that the majority of these acquirers did provide information about how they valued different types of identifiable intangibles that they acquired. Although none of them provided quantitative information. They sometimes would describe the key valuation inputs, but they didn't usually give quantitative information. But the bottom line is that it seems like disclosure is somehow possible. I mean, it seems to happen under US GAAP. So that's the first research question. Now the next one is how do investors perceive the value of different types of intangibles? So to do this, we basically collected the different classes of intangibles that firms report. So the names of the different classes and the closing carrying amount of the different classes of intangibles. And then we categorised them into 6 categories, as you can see there. So we basically looked at keywords to separate out the different types of intangibles. So you can see we've got brands and customer-related intangibles. So those will typically be acquired in business combinations because you can't, recognise internally developed brands. Software and development costs will normally be internally developed intangibles, although they could also be acquired. And then we've got intellectual property and licenses. So that's what we did. And then we've got some descriptive stats here. So you can see this is the number of classes that firms broke down their non-goodwill intangibles into. So you can see that the vast majority of firms report 5 or fewer classes of non-goodwill intangibles, and median is 3. And then this is the frequency with which the firms in our sample reported the different types of intangibles that we're looking at. So you can see, because our sample is kind of skewed towards firms that have a lot of non-goodwill intangibles, you can see that the frequencies are quite high. And you see the majority of firms reported brands, customer-related intangibles, and software. And then fewer firms reported the other types of intangibles, licenses, intellectual property, and development costs. But I think we've got a high enough frequency for analysis. All right, so this is where some econometrics come in, but we're not going to get too deep into that. But we've got some academics here, so I thought I'd put this here. So how we do this type of thing in accounting research is we do what's called a value relevance regression. So it's basically saying how is the share price, which is the market value of the company, related to its earnings and its book value of equity. So these are the 2 summary numbers from the income statement and the balance sheet. What's the net assets or book value of equity? What's the earnings? And then you would expect that if a company has more of those, it'll be worth more. And this is saying how much more is it worth, the beta 1 and the beta 2 there. So that's a basic value relevance regression, very standard in accounting research. And then what we do in our study is we break down the book value of equity into the different types of intangibles. So we can break out the goodwill, the brand names, the different, what's the closing carrying amount of each of those different types of intangible. And then we can see what value the market is putting on the different types of intangibles. So I put the regression output here for the benefit of the academics in the audience, but it's not something, perhaps if you don't look at these every day, it might be a bit hard to look at. So I'll just sort of focus more on what the implication of this is. So basically we find that brand names are valued by the market, but they're not valued in a way that is statistically different than goodwill. So the market seems to value goodwill and brand names basically the same. This is consistent with the US evidence that I talked about before. The market doesn't seem to, on average, value customer relationships or customer-related intangibles. You can see that that coefficient is not significant. So for some reason, the market views customer-related intangibles with skepticism, probably because we don't really disclose any information about how the fair value was determined, because this is something that will always be externally acquired. And then software and development costs are highly valued. And of course, these are internally developed. They're measured at historical cost. They're capitalised expenditure. All right, so I'll skip that. That's just some robustness tests for the benefit of the academics. We ran some different robustness tests with the value relevance regressions and basically get the same results. So what does it all mean? So we've got a scenario where firms are buying non-goodwill intangibles in business combos, recognising those at fair value, but then rarely providing disclosure about how those fair values were determined. Now, disclosure might be possible because we do see some firms voluntarily provide this information, and then US firms seem to provide this, so it's more common under US GAAP, so it may be possible to actually provide this information. And the market basically views goodwill and brand names as being essentially the same, statistically indistinguishable in terms of value relevance. Views customer-related intangibles with suspicion. We couldn't find any value relevance for customer-related intangibles, but views internally developed intangibles as very valuable. So you can sort of see the connection between these results in the sense that we're not normally disclosing any information about how these intangibles, how the fair value of these intangibles was worked out, and that therefore might affect the way that the market perceives the value of these intangibles. The market might say, well, I don't know how the brand name fair value was worked out, so I'll just treat it as if it was goodwill, essentially, not place any different value on it. Of course, what we can't say is the counterfactual, as I've said there at the bottom. So we don't know what would happen if we did provide more disclosure. Maybe investors would behave the same way, or maybe they would view brands and customer-related intangibles as having a different value than they do at the moment. So what do I think? Maybe we should consider providing some more disclosure about how we work out the fair value of identifiable intangibles in business combos, especially where they're highly material intangibles. So you've got large intangibles going onto the balance sheet at fair value. How are those fair values worked out? We do provide this type of information if we carry an asset at fair value after acquisition, but we don't do it when we buy them at fair value. Should there be more guidance in AASB 13 on how to value intangibles, maybe borrowing some ideas from the international valuation standards? Perhaps. Then the other option, of course, is maybe we should just not separate as many intangibles from goodwill. Maybe it's not worthwhile, for example, separating brand names from goodwill, given the market seems to value them about the same way. So that's it. That's all I've got. Thank you.
Thank you, Mark. I'll invite you to join our panel now. So the panel discussion will start shortly. We would like to highlight that the views and opinions in the discussion do not necessarily represent the views of the speakers' organisations unless explicitly stated. All right, joining the panel discussion today, we have Moana Overton, Shiva Sivanandan and Tiffany Tan, moderated by our AASB Research Director, Dr. Eric Lee. Please join us on stage, Moana. Moana is a partner in accounting and corporate reporting at Deloitte and a current AASB board member. With over 2 decades of experience across Australia, New Zealand and the UK, she specialises in technical accounting advice, policy development and guiding responses to changes in standards and legislations. Our next panel member is Shiva. Please join us on stage. He is currently a Director of Accounting Policy and Financial Reporting at the Department of Treasury and Finance Victoria. He brings experience from previous roles at the Victorian Treasury and Finance Victoria, previous roles at the Victorian Auditor General's Office and Grant Thornton Australia, with a robust skill set that includes IFRS, auditing, accounting and consolidation. Shiva brings deep expertise in financial reporting and policy development. Our next member is Tiffany Tan. Tiffany is the Audit and Assurance Lead at CPA Australia, shaping policy and advocacy on emerging audit and assurance issues. She works closely with standard setters and regulators to enhance audit quality and help the profession adapt to technological change. Please join me in welcoming our panel members and our moderator. Thanks, Eric.
Thanks, Janani. I really liked that presentation just now, Mark.
Oh, thank you.
What you did was, how you explain regression model in a plain language that we can relate and understand. I think that's what we're looking for when we are requesting academics to explain how the research papers, how we should understand them. They are complex, but how you did it, really helpful. Thanks, Mark. And so in the last 2 days, we heard about intangibles, we heard about valuations, we heard about disclosures, and I feel like these sessions wrap everything together in just that one content. And I'm going to have a few questions for the panel as usual. The very first question I would like to start with is, for all panel members, except Mark, do you find the research presented today useful and meaningful in your respective roles? What stood out to you? Any surprises or no surprises? You're looking at me, Mo. I'm going to start with you.
All right, great. So, Mark, I loved your presentation, and I don't know what Eric's problem is, so let's just start there. But I do think it's really useful, and I suppose that my biggest reflection is we find a lot of cynicism when it comes to intangible asset valuations, and a lot of that is justified, but some of it is not. For instance, you see in the press and the like, views anywhere from intangibles are wildly overvalued in this country to intangibles are entirely undervalued in this country, and anything in between. And I think I'd probably like to reflect for a moment on what I see from my valuation colleagues, and I'm not a valuation specialist, but when I look at the models they are running and the way they are trying to determine value and the extent of the data sets they are using to support that value, I think I hear a lot of noise in the market that some of that is fairy dust and magic wands, and actually I think there's a bit more science behind it than perhaps we fully appreciate. But the biggest thing, of course, is the underlying assumptions, which to Mark's point are the absolutely missing disclosure from, I think, all of the data sets you spoke to, because knowing that someone used a relief from royalty method is only vaguely interesting. Knowing that they used a relief from royalty method and this is the royalty rate, well, that's a whole other level of interesting, and then may support, as I think you suggested at the end of the presentation, that if people better understood what was feeding into that brand valuation, they might then place more value on what that brand valuation is telling them, as opposed to seeing it as essentially a balancing number, no different from goodwill.
Thanks, Mo. Siva.
Thanks, Eric. Mark, that was fantastic presentation. Thank you. I had a couple of reflections going through the presentation. Firstly, I was surprised that we are not disclosing material, intangibles that are coming out of acquisitions, because I would have expected, I know, Mark, you said throughout the presentation is voluntary disclosure. Yes, we don't have any explicit requirements. But if you look at 101, that basically says any significant judgments and assumptions, etc., you need to disclose it. So, subject to it being material, I would have expected there would have been some robust discussions between the entity and the auditors in terms of, what goes in. So I was a little surprised on that. Second, I think there was a comment somewhere in the slide deck, Mark, that said customer-related intangibles weren't overly value relevant, which surprised me a bit too, because I would have thought if an entity has long-term customer contracts that is a particular value, that would be quite an important information from an investor perspective in terms of the pipeline of revenue coming through, etc. So I was a little surprised on that. I can understand customer relationships compared to customer contracts, because customer relationships can be more like a goodwill, and maybe it can be, similar to goodwill. But I would have thought customer contracts is pretty value-relevant information. So yeah.
Thanks, Siva. Tiffany.
Thanks, Mark. I thought the presentation was really good. So I think we hear a lot of noises in the market. With the research, it confirms a lot of understanding. So I want to go back to what Moana said about valuation. I also heard a different perspective of valuation. A valuer actually once told me valuation is a lot of art, a little bit of science. Because when I challenge, my background is being an auditor, but I also have a couple of years in the valuation practice of my firm. When I challenge, how do you come up with that value? Why is it always multiple of 4? I can't explain that. It's going to be a lot of art. It's what you know, it's a bit like that. In terms of whether I'm surprised or not with that presentation, I think a little bit surprised, but at the same time not. And I actually quite like the end of your presentation, Mark, where you asked really good question about if goodwill and brand are all intermixed, we don't really care, or the market doesn't really care, then do we really need to spend so much money? Because we know valuation is expensive for both the entity and also the auditors, because it's getting a lot more complicated and the valuation model is very complex. Therefore, when the clients have a valuation expert to do the PPA or purchase price allocation, and you often also involve an auditor's expert to actually evaluate the report and come up with their own assessment, objectivity comes in. So I really like that, the research and how it will sort of reset the thinking. I think a lot of the session today and, in the whole ASB forum so far, it's really challenging how we rethink accounting in general, and especially with intangible AI and all these soft numbers that we talk about. What is the purpose? What is the cost? What is the benefit? Are we actually meeting the user's target? Like, is it helpful to the user, or is it just another thing that is for? I know it's controversial for me to say that because coming from an auditor's lens, it's all about transparency, but at what cost? Thank you.
Thanks, Tiffany. Mark, would you like to provide a response to the comments you received?
No, I mean, those are excellent comments. And one thing I will follow up on is Siva was saying, you know, you've got the general requirement in AASB 101 to discuss material sources of uncertainty. So when the firms did disclose, voluntarily disclose this, they often referred to that. But it doesn't seem to be in general something that firms don't seem to view that as in general operative, right? So the firms that voluntarily disclose it often mention it, but most firms seem to view it as not something that binds them to have to make that as a mandatory disclosure. But I did think of that, but that's an excellent point. But yeah, I mean, we did break out customer relationships and customer contracts as separate types of intangibles and found basically the same results. But I definitely agree with you that I think customer contracts are probably more credible and more likely to be value relevant. So I might take a closer look at that. But yeah.
Thanks, Mark. So, again, we talked about this 2 days ago. That is, how can we improve or increase investors' confidence with the disclosures of valuations? Can we ever reach there? Question for you, Mo?
Look, I think we can improve confidence because the more information an investor reads about the valuation, the more opportunity they have to say, I agree or I disagree. Right? So if I know you used a relief from royalty rate, then, well, probably if it's a brand, good on you. If I know what rate you use, then actually I can, if I understand relief from royalty properly, bring my own lens to whether I think you've overstated it or understated it. And those disclosures are almost entirely missing at the moment. Will we ever bring investor confidence to where it might be on the value of widgets or property, plant and equipment? Absolutely not. And I suppose that the reason for that is that intangibles are, by their nature, intangible. Now, Eric, I think, was blessed enough to be a member of my team at a point at which I mounted the argument that, in fact, my car is intangible because it actually represents my right to drive wherever I want to, when I want to, rather than necessarily being particularly interested in the car itself. But if we think about what intangibles are, they are a right to do something, a right to sell under a certain brand name, to contact a customer without breaching data privacy laws, and so on, but we don't really explain what that right is quite as clearly as I just explained what I think the right my car confers on me is.
That's a very good analogy. Do you have other comments, Siva and Tiffany?
I think you've summarized it pretty well, Moana. The only comment I was going to add is we can never bridge that gap fully. There is always going to be a gap. It's about how close can we get to. I think these days we talk a lot more about disclosure overload too. That's something we need to be mindful of. Yes, more disclosure is good, but are we really articulating, providing it in the most meaningful way? I think that's something to be mindful of because we can keep adding, more disclosures for investor demands. And I think in practice, one of the areas people often struggle is that concept of materiality, which popped up quite a few times over the last few days. People really struggle on that. If you can't apply materiality in a rigorous way, you're going to struggle to meet the information needs. So I think that's another important thing to consider.
So, Tiff, hearing from everyone's comments, I've got a slightly difficult question for you.
Please not.
Do you think it's an issue of the standards, issue of the behavior, or issue of the enforcement, that is the auditor's job to making sure that they are being disclosed?
Can I say all of the above? Starting with the standards, I think. So you have a discrepancy or disconnect already in terms of accounting standard, how you treat acquired intangible versus internet-generated intangible, right? So that already sent a very, it's not to do with anything else, but I'm not criticizing the standard setters, but that sent a very difficult message, a different message to the user of the market, right? And especially we know that investors, not all investors are sophisticated investors. And I want to go back to, so that's one issue. The other issue also is we all know, we're a lot of technical people in the room, so I don't need to preach to the convert. Anything with intangible fair value especially, it's very subjective. The value is subjective. But I think the common user in the financial statement perspective, they took every number in the financial statement as a precision. They say, if fixed asset is X, intangible asset is why I don't really care whether it's goodwill or customer list or brand. It must be right. So what they don't understand is with those intangible value, a lot of estimation go into it, judgment. And in fact, I think, Mark, you got a presentation earlier on that talk about one slides that you review the US reporting, where they have multiple methodology, right? Combined methodology that you use, right? So that give you different valuation. And I've done valuation a little bit, so I know that. And also the assumption that you put in the input, the valuation input, you know, whether you're being aggressive, not aggressive. And we all know, in the auditors in the room, we all know about the stretch analysis, right? So it's a range, it's not a precision, that's one. Regulation, so do we say regulation? Okay, so from a regulatory perspective, obviously, auditors has been, you know, on the spotlight a fair bit. So we get the heat all the time. It's a very highly regulated profession in the world, apart from doctors and stuff. So to get it wrong, it's hard. So the only way we can sort of help sort of convey the message is really telling the story. And accounting standard doesn't help because Mark has said that there's lack of disclosure in that sense, right? So I think sometimes that it forces the auditors to put those disclosure that's supposed to be in the financial statement into key audit matters. For example, in the worst case scenario, it could be emphasis of matter. In the, you know, like it depends on materiality. Again, it goes back to that. What was the last one? I can't remember, but you talk about 3 things, but I think I've addressed 2, and I might stop there.
It's all right. I'm just getting if there's any question from the floor. If not, I'm going to keep going and ask the next question to Siva. We haven't heard much about the public sector perspective, and I'm wondering, do you have any insights from the public sector's perspective?
Sure. Obviously, government's not in the business of acquisitions, so it's really an issue in our context. Having said that, we have what we call the machinery of government changes, which is basically internal restructures of departments and agencies and all that, more like a common control transaction in the IFRS world. And we generally book them based on carrying values, which are largely fair values, etc. When it comes to intangibles in the government space, you will see, I think, Mark, in your presentation, you said 10% of those non-goodwill intangibles were, the balance sheet. In our case, it's much smaller. It's about 1% in terms of the total balance sheet of governments generally. If I can talk about the Victorian government, for example, we've got about 5.8 billion worth of intangibles. You might think that's a big number. It's not. Because our total assets about $565 billion. Of that intangibles, we have a policy around cost generally. Obviously, under 138, you can't do fair value unless you've got active market, etc. So most of them cost. Having said that, we do have some assets that are intangibles that become service concession arrangements under 1059, for which we have to value them at current replacement cost. So for them, we have to come up with fair value. So these assets, examples would be big roads, for example, registration, licensing, custom plates, database. They were internally generated intangibles. We didn't book them. All of a sudden, we had this public-private partnership. We booked $3 billion worth of intangibles. Similarly, land titles database, Land Use Victoria and all that. So again, that's about 600 million intangibles. So those ones, we have to book them at fair value, and we have our fair challenges in terms of coming up with that current replacement cost. In fact, one of the feedbacks that we provided to the AASB as part of the PAR of 1059 was to say, maybe don't restrict us to current replacement cost, just give that option open within AASB 13 for us to pick the most appropriate method, because at times CRC is particularly challenging.
Anyone else want to add any comments to that? No? Okay. Any questions from the floor? No? Right, so we're going to move on to the next question from the audience, actually, which I think it's related to many of the audience here today, including those that are watching from the virtual platform. It is about how to prepare our talents. So I think there's an expectation in the market that accounting or accountants should have some sort of level of knowledge about valuations. But if we ask any accountants in the room, I don't think many of us would have the confidence to say that I know a lot about valuations. So the question is, how should we be preparing accounting students to understand and navigate the complexities of valuations? No.
So look, I think when I went to university, I did have to do a module on valuations as part of what was then the Institute in New Zealand's sort of compulsory, these are the subjects you must do. I suppose my reflection on that will be, I looked at a lot of fancy formulas, a bit like the ones you stuck up. I realised those weren't valuation formulas, they were regression formulas, but for me, I'm afraid they are both as incomprehensible. It's not my jam. And I didn't understand the implication. That's probably really where it fell down for me on that front, is I think if I had then done some valuation experience as part of my work and understood the implications of what was in front of me, that would be more helpful. The theoretical, learn this at university and never use it again, just means I've ticked a box that I was told I needed to tick to get the qualification I wanted to earn.
Within public sector, because we do fair value a lot, because we have to align with GFS framework, which is very much market economic based valuation. I did my university about 20 years ago, and at the time I didn't have an option to do a valuation subject. Hopefully there are those options now for undergraduate people. I think that would be particularly useful. Obviously there are students, who prepare to work in the, for example, public sector space or where valuation is quite predominant. So for them, I think that option would be quite useful if that option is available. But in practice, we spend a lot of time with Value General Victoria, other valuers and others. And obviously AASB 13 is helpful because it talks about some of those things, but the actual implementation is much more judgmental.
Tiffany.
I have to agree with Moana. Lived experience is the way to go. I'm a person that learned by doing, not just by reading. I read 2 sentences and I fall asleep. But because of my valuation background a tiny bit, it really does open up a lot of contextual. So for example, if you have valuing an asset that is like a mixed use, a part of it is for rental, the other one you can sell, and you can't just use one model. You need to know the context, what you're doing. And also as an auditor before that, when we are looking at management experts as well as our own experts, sometimes you get a lot more perspective when you see these 2 reports presented to you, but they're completely different. Then you are in the middle trying to negotiate and understand what is the context the management experts come from. Did they take in synergy in their valuation? And they shouldn't, because 13 tell us not to. And then the other one is the auditor's expert. Sometimes auditor experts, if you don't brief them properly, they might get it wrong. So it's not always that objectivity trumps everything else. The logic, the context is really important. And being an auditor, I think to have that background of understanding what valuation really means, even though we don't know the technicality of how to do it properly, it's really important as an auditor.
I agree with that, and I think what I'd add to that is when we find we have our most helpful conversations with valuation experts is actually where we and our valuation experts have been able to sit down with the independently appointed valuer up front and say, actually, this is what we will be looking for to support as audit evidence. Where a client goes off and gets a valuation from Bob's Valuation and it comes in with 79,000 caveats and doesn't take us very far, that's really hard. Whereas when we can all sit down together and say, we're all got slightly different lenses here, but this is really what we're targeting, it is far more productive, far more positive, and results in the client better understanding their own valuation, which is really important when they're then feeding up to directors, this is what this number means. Us being better able to assess, challenge and understand what has been done and for what purpose, and whether it then suits our audit purposes or what other procedures need to go around it. So
that's basically back to Tiffany's point that evaluation is art. You guys sit together and basically you're trying to judge what art looks better. And that's quite subjective in a way, isn't it? Yeah. Mark, from an educator perspective.
Yeah, so I agree that a lot of these valuations will be very subjective. There'll be a lot of professional judgment involved. But that's why I still think disclosure is the best way to do it, because then you're saying let the market decide if it likes this estimate or not. But yeah, the problem is the curriculum is very full. We've only got 3 years with the students at university. I personally think I'm in the minority when I say this, but we should be teaching sort of theory and the kind of principles behind accounting and finance and whatnot. And then students will get plenty of practice in the real world, and they'll do a CA or a CPA and get more practical experience. So I think our role is more to, teach them the issues that, would be involved in valuation, what are the different ways to do it at a high level, and then they can get the practical experience later on. But yeah, I mean, I teach valuation financial statement analysis, but I don't have room to fit, like the discussion of relief of royalties in there. There's too many other things to cover. It's a very tight. We're constantly being asked to cover more things in the 3 years that students typically have with us, and they only take 8 subjects of accounting typically. So it's a bit difficult to fit it all in. But I mean, I certainly think, high level understanding of what a discounted cash flow model looks like and things like that, what the discount rate, terminal growth rate, those sorts of estimates that go into it. That should be something that students should get some exposure to ideally.
Thanks, Mark. And we're right on time. We've got 20 seconds left. So with this, I'm going to thank my panel members. What a wonderful discussions. Please give them a round of applause. So now we're going to have our afternoon tea. It's going to be a short 20 minutes afternoon tea, and we'll be back here at 2:50. Thank you.
None of the questions that you said last night, it's asked. You will do.